Hi, everybody. Welcome to another episode of 10,000 Roads to Financial Independence. Today, I have my guest, Juan Vargas. Juan's a good friend of mine. Juan is an accredited multifamily investor based out of Houston, Texas. He has been involved in all aspects of real estate investing within multifamily since 2015. He has transacted on 1,600 units valued at over 125 million throughout Austin, Dallas, Houston, and Phoenix. And he is a JV partner on additional 500 units throughout Texas and Georgia. In addition, he is a limited partner on over 1,000 units as well. So he passively invests himself. Welcome to our show today, Juan.
Lisa, thank you so much for having me. It's my pleasure. Excited to be here. So let's do it.
Awesome. So Juan, we always ask our guests this question, which is growing up, who do you think influenced you most as an entrepreneur and then shaped the way who you are today?
Yeah, so I would say it's definitely my dad. Both my parents. My dad had he was a welder by trade, and so he would go to work at his job welder, and then he would come home and he had his own small business, and we were actually involved in that small business as well. Welding at the age of 11, 12 years old, and just really building these trailers, So people will come over and like, man, these little kids are here like welding and building these trailers. Yeah, we built it from the ground up. So I think, ever since I was a little kid, like he pushed us towards that, taught us to work hard with our hands. My mom later on as well, opened up her own restaurant, and she had that for a while, and recently sold that. And so I think it was just one of those things where, we're an immigrant family, entrepreneurial, and it just kind of stuck with me. Although I didn't go that route like immediately, but eventually I did.
Yeah. But not welding, not like small business. So you kind of figured out a way to scale your business as well. Yeah. That's awesome. So walk us a little bit more about, you had a full-time job before, like a little bit your journey to the financial independence or just being your own boss.
Yeah. Well, I will tell you, it wasn't easy. Like it's not like, I think, if you have a W-2 job, you dream about that potential possibility of you being financially independent. And that certainly was something for me. There's a ceiling in some of the W-2 jobs out there, right? And I was hitting that ceiling as far as like, salary, pay. And I knew that I was much more capable out there, doing something else, right? And then I had the entrepreneurial bug that kept, just itching. I was like, I need to do something about this. And really, the turning point for me was, reading books. As many of your audience has probably, also can relate. Rich Dad Poor Dad was a good book that sort of like really triggered me to say, okay, this is enough. I need to, I was already wanting to do this. I need to just do this now.
Yeah.
And so, yeah, that kind of pushed me over the top a little bit. And
then you later interviewed Robert too, right? Like that's kind of really going full circle.
Yeah, no, that is, yeah. Through a podcast, I was able to interview Robert Kiyosaki, and you guys can catch it on YouTube. But it was a fun experience. And then later on, still, I got to meet him in person. So it was just like, it was really cool to be able to meet him, and somebody that you look up to, right? And has really impacted so many people out there, right? A lot of your audience has been impacted, by that little purple book, right? So it's just a really good thing. But yeah, I would say that just having that itch and that desire, that drive, pushed me over to getting into the entrepreneurial side, which for me was single family homes. And it was just a couple that I started with before I made the transition into multifamily.
Got it. So you started from single family and go into multifamily. What's the thought process behind, hey, I should be doing multifamily versus single family?
Yeah, for me, it was very simple. I had one of my properties was vacant. The resident left. I marketed the property, and I did everything I could, per the book. I had applicants, but they weren't qualified as well as I wish they had. And so the property sat for a little bit over a month vacant. And guess what? You still have a mortgage. You still have utilities. You still have, you still have to put money into the property to fix it as a turn to get it ready. And so all those things combined really pushed me over the top and said, you know what, it's my mistake. It was my fault because I was relying on one person versus multiple people. And then I wouldn't be in the situation where I had to like pay out of pocket to get things fixed, right?
Right.
Or pay the mortgage, right? So that was really the light bulb that went off for me. And shortly after that, I got into multifamily. I said no more with single family. I'm done. I'm selling them. And luckily for me, it happened quickly rather than later, right? Sooner rather than later.
Yeah, definitely. And it seems to be a big gap when you're jumping from single family to multifamily. So if you can share with our viewer a few tips, if you have to do it all over again, what are things that you would suggest our viewer do in that jump? Yeah.
So number one is, as everybody already knows, like you have to know the language, right? You have to know, educate yourself as much as possible, right? Make sure that you have your ducks in a row financially. Make sure you have your ducks in a row with as much knowledge as possible. And here's the thing: we're gonna know everything, but know as much information as possible. And then, if I could go back, well, for me, it was a situation to where I wanted to dive in with both feet and jump into multifamily. I was just ready, and I think if you want to be able to reduce your risk, then I would say definitely if you're able to get educated and have your finances in a row, then make sure that whoever you work with, whoever you go to buy the property with, make sure that they have experience. I would say the first one, even if you're giving a little bit of piece to somebody that has experience, that they can guide you through the process and where they have a little bit of skin in the game maybe as well, then I think that would be one of the biggest ways to be able to reduce somebody's mistakes, in a big way. And so that's what I would say. I didn't do that. Luckily for me, I didn't really make many mistakes, but maybe it would have definitely, lowered that learning curve, and made things a little bit easier for me.
Yeah, so maybe saving some time, and then time is money to basically to most of people, especially when you're investing. And then also, so you made that big gap, you made that big jump. I understand that you own some property yourself as well. Where do you get the capital? Oftentimes people ask the challenge on multifamily investors, like, I'm going to do single family today, and then I work my way up to multifamily. Great. But where do you get the capital for your first multifamily?
Yeah. So for me, that very first one, whenever I was working W-2 job, I forced savings, right? So it's automatically deducted from my account. It's like boom, it's done, and then whatever was left was for me to pay bills and to play with, right? And so it was like a forced savings where I was just automatically saving a majority of the money that was coming in, and it was like, I'm not touching this. It doesn't exist. You kind of like set your mind like that, right? So I thought you can save, because if you allow yourself to access that money, then it just makes it so much more difficult for you to be able to really truly save, right? Because you're telling yourself, well, I have this little bit of a cushion here. I can always tap into it, and you will. So I just kind of locked it up basically, if you will, and that's what I did, with my first property. But I would say that I did bring in a partner on that first property, and we were able to he was able to bring in some capital, but I was willing to sell my primary home because I had built up so much equity. I was willing to sell it, and I actually, my first partner, I'll just say this really quickly. My first partner was he's a general contractor. He's a good friend of mine still. He's invested with me multiple times as an LP. But he was my first partner on that deal, and he came over to the house and he said, "Hey, why are you trying to fix it? Like, what are you going to do?" And it was just little minor things. And I was like, you know what? It's because I found this property that I want to buy, and for me to be able to buy it, I need to be able to sell this property. And he's like, "I'll take care of this, but you don't have to sell the house." And this is with me with a wife and kids. And I think you have to be able to put yourself out there and take those risks if it is that something that you really want. I figured, hey, I'm young enough to be able to recover if I make a big mistake. I can recover, and money is not, if you lose a little money here and there, it's not the end of the world. You can, as long as your family is healthy and good, that's really the most important thing. Right. So that's what I told myself, at least,
Yeah, definitely. And then I think you must have a really great wife, for you to do that as well.
Yes, yeah, she's awesome. She's my rock. I think that that's another thing. It's, if you have that spouse that supports you. I know you have your spouse, and he supports you 100%. I think if you have that, it really helps tremendously, because, if you feel down, or you feel like things are not going right, they're there to support you no matter what. And like that, you're able to pick your head up and keep pushing forward.
Yeah, definitely. And so here you are, you started your first multifamily journey. Are all the projects, I would imagine none of the project is as expected. Either they're better than what you expected or worse than you expected. This is how the game of multifamily goes. So going from, owning, I don't know how many units were your first deal?
Yeah, the first year was 32 units.
Okay, 32. So that's pretty big because most people start with maybe fullplex and maybe like a couple teeners. And so 30 units. What did you kind of gone through that? What is that first property experience?
Yeah, that first property was actually a very cool experience. As you know, that was my first multifamily, so I didn't have any experience doing it before. So it was a little bit of a challenge with getting financing, debt, and so that was a challenge in and of itself. But once you're able to kind of go through that, then and close on the property, then there's the operational side. But see, for me, what really helped me was my partner was a general contractor. So he was able to take care of a lot of these construction piece to the deal. Whereas if you haven't done it before, then it could be a challenge, right? Because you're learning
Right.
just the language itself, right? It could be challenging. And so he was able to take care of that, and we managed the property, we operated the property, and so it was a good teamwork. So I would say, yeah, that's good. Go back to my point, is it's good to, if you're going larger and because you can't do it yourself, or simply because you don't have the experience, bring in somebody that has the experience. And that's really the key to the success, I think, in these deals.
Yeah, definitely. And so from there, how did you then jump into larger multifamily?
Yeah, so my first couple larger deals were actually JV partnerships, partnered with other experienced operators. And here I go again, saying that, and they had done a couple, and so I worked with them, and we were able to knock those out of the park. But from there, as I got more comfortable, I also invested in some LP deals, and then also was able to move forward and take down my own deals as a syndication, not like me by myself. And so I don't do too many LP deals anymore, but a lot of those have come full cycle and have done really well. So there's a good opportunity. I'll certainly be happy to still.
That's awesome. And then what did you learn from these LP deals?
Yeah. So what I learned, I mean, a couple of reasons why I did it, because my goal was to be active from the get-go. But a couple of reasons why I did it was, number one is always to make money, right? You don't invest unless you're going to make money, right? So number one is to make money, but also what it gave me was the opportunity to be able to look behind the curtain, if you will, from some of the more experienced operators at that time, and see how they're doing their business plan, why they're making certain decisions, why they're choosing this or choosing that, and just operationally, right? So I was able to pick up some things that I liked from them, and then also some things that I didn't like, and for my own deals, was able to purposely keep out the things that I didn't like, and maybe cater it better and make it a better experience for our investors.
Yeah. So can you kind of highlight being an LP, if someone's kind of just thinking about passive investing,
For sure.
is there any tips you can share with them? Have you seen the signs of things that you didn't really like before? How would you do it differently? Like, can you share some tips on like how to select the right, your first project to passive invest in?
Yeah. So I think the first things is we always say for us is picking the right horse, right? Which means picking the right sponsor, right? Having a sponsor that has some strong experience and knows the market well, and try to get referrals or try to get some references, I would say, right? Where you can find out more about how they operate, right? Those are key items, but also doing your own homework and understanding the market itself, right? If you're in Texas, like I, we all know Texas has been booming for decades now. So it's a little bit easier. But if you're like in the Midwest somewhere, you want to invest in your own backyard, then really understanding the market, because it doesn't matter if you have a good operating, the market can really make an impact as well. So understanding as much as possible, right? And all know that you're not going to have all the answers, to making a decision. Feel 80-90% good, and then if you're not sure about the last 10-15%, then I think it's still good chances to pull the trigger on.
Yeah, definitely. And we noticed that you're in multiple markets, and like, how did you get into multiple markets? How do you feel comfortable investing outside of? I mean, a lot is in your backyard where you live in Houston, so Austin, Dallas. Austin's pretty close, and Dallas is just 5 hours to drive away. But you're also in Phoenix. You're also in Georgia, which is kind of far. How do you then scale yourself into these different markets?
Yeah. So Georgia, that was a co-sponsorship opportunity. And so I have some strong sponsors that really ran most of that one. And then for Phoenix, that was us. And so there's certainly some challenges with buying remotely. I think it's number one, if you're not living there, try to have a partner that's local if you can, right? Because that would reduce, it can improve operations to a point, and you're able to be in the know all the time. And so that's number one. But number two is having a strong property manager, right? Because if you're not going to be there every day, then you need somebody that's going to be running the property on your behalf and going to be making the best decisions as possible, right? So I think those two things are key to being able to really run a property remotely, right? Having access to good vendors, right? I hear people, saying that they want to go to secondary markets, tertiary markets, because pricing has increased so much in the primary markets, and it's like, okay, well, what about your team out there? What about your property manager? How many have you interviewed? What about your vendors, right? If you don't have all that, then it doesn't matter what you buy it at. You might buy it at a better pricing, but at the end is going to cost you more because you can't do any of the work, or you're not collecting rents, you're not taking care of work orders. So I think it's very important that you have those pieces, and then try to get to the property as much as possible yourself,
Yeah. And how do you start assemble these? Like, if you just brand new to that market,
Yeah. So if you're brand new to the market, I would say a lot of it comes from broker referrals, right? So if you're like, for me, for example, we're talking about Phoenix. I want to go to Phoenix, and first thing I would do is say, hey, reach out to the brokers, and then once you get a good relationship with them, built up pretty good, say, hey, who do you recommend here that's a good property manager? Like, who's your go-to that you would use on your deal if you had a deal? And they'll give you a list of like 2 or 3 or 4, right? And then you start reaching out to those guys, and then start interviewing them, and maybe reach out to other people that are in that market and asking them, hey, have you used these guys before? What do you think? How was your experience? How did they run this process? How did they run that process? And then you're able to take it from there, make your own decision.
Yeah, that's awesome. It's great nuggets over there. And you said you don't passive invest in too much anymore, but do you still passive investing? Like, how's that criteria not changed for you?
Yeah, so I would say I don't anymore. I just haven't, right? Because I've been focusing more on my deals, but we have like another deal that's coming full cycle as an LP. It was actually my very first LP deal, and it was a good one because we got 100% cash back, cash out refund, and then we're gonna make another 200+%, right, on the sale, right? So it's crazy because it's things start coming full cycle. You start to understand what it is that you like even more so. Like, your criteria becomes a little bit more crisp, and so the people that you would invest with are people that kind of see the same things as you, and have some better experience than you if possible, and then just really understand the market, especially because things are really heated in today's market, right? So you got to really be careful out there.
Right. That makes sense. That totally makes sense. And what is the current economy environment? The fact that there's a war going on, interest rates are kind of going, possibly going up, and the stock market going wacky. What do you see? How does the economy kind of changes your investment strategy at this point? or does
You
it
know,
change?
that's a great question. And, for us, it does change to a point. It's always up and down, right? Like as far as interest rates, it's going to be up and down no matter what.
Mm,
But guess what? People have made money in every single economy, right? Whether we're in a great
mm,
economy, whether we're in a bad economy. I mean, there's opportunities out there no matter what. People were making money whenever it was like 10% plus, interest rate, and then
mm,
3% interest rate. So it's just being strict to your criteria and finding good markets overall. I think that we're ever more becoming a renter nation. Day by day, population increase. We're having
mm.
household formation. I mean, if you look at just the fundamentals in a market, in today's market, I mean, they are still there, and we just don't have enough housing overall in the nation to support the demand that's out there as well. So despite interest rates going up, I think that we still continue to look, and we continue to buy, and just you got to make sure that you cover your bases, and try to be as conservative as possible. Still, that
Mm.
doesn't change, but yeah, we buy. We were still buying. Yeah.
Yeah. And I understand that you have a podcast. We kind of mentioned a little bit before. I believe you, like, when did you start that podcast? And
Yeah.
you know,
Yeah, that was back in 2018. And had a good run. I'm not active on it right now. But we're thinking about bringing it back online here very soon. We
mm,
had Grant Cardone, we had Robert Kiyosaki, we had a bunch
oh,
of awesome people on the podcast, and it was fun. It had a great time. But as we got a little bit more busy with our deals, and really shifted a little bit more focus onto that, then we put it on pause. But certainly it is
yeah.
fun. I loved interviewing people just like we are right now, and as you can tell, I'll just keep talking forever. But but yeah, no, it's fun. It's definitely fun, and so just need to relaunch it, or maybe season 2 or something, right?
Yeah,
So
yeah.
yeah.
And what's your secret on landing these big shots, essentially?
Um, yeah, for those, I would say that there's really no secret. It's just being persistent, right? Because you reach out and there's like nobody replies, or you reach out again and again, and then somebody finally replies, and it's like there are like so many like levels away from the person. You just have to keep pushing to climb the ladder. And that's exactly what I did with those 2 opportunities. Just kept being persistent, and then whenever it finally came to, like, for example, with Robert, he's like, hey, his direct assistant was like, hey, you can do this Friday, and it was like a Tuesday. I was like, you make room, right? You make room
Yeah,
on your schedule, and you make it happen, right? And I was like, okay, well,
yeah,
let's do it. So that's kind of the way it happened, right?
yeah.
So you're kind of on their schedule, but yeah, it's just being persistent, and not necessarily taking no for an answer. No is just the beginning of the talks.
Yeah, of the yes, potentially. Yes,
Yeah.
obviously. That's awesome. And you kind of shared with me a little bit before in the green room. There are a few projects that you worked on. They were a little bit more challenging than the other. Now,
Mhm.
and I asked you, are most of your strategy deep value add? Deep value add means there's quite a bit stuff to lift, whether it's tenant demographics, that you clean up a lot of underserved communities, or it being a physical uplift, etc., usually comes together. So between kind of like you've gone through a slew of whether small deal, large deal, deep value adds, light value adds. Does that kind of help you clarify your criteria and selection, and what that would be? What's your criteria today?
Yeah, you know what? That's a great question, and I think you're right. I think it does help to solidify your criteria, right? Because at the very beginning, you're gonna have, okay, it's gonna be the middle of the road type of criteria, but as you actually go through the experiences, you're like, wait a minute, maybe I shouldn't focus on this so much, or let me just change a little bit. And
Mm,
so yeah, those I would not take those. I would not give those experiences back. I think they've been very very helpful and
mm,
valuable in from an experience standpoint,
mm,
and helping us to be able to understand our criteria even better, and know what to look for next. Your second question was, what's our criteria today? Yeah, so our criteria today is uh, trying to focus more on the B product, in primary markets, right, with the value
mm,
add opportunity. And we can certainly go a little bit more like a C plus, because there's opportunities in those as well. You just got to make sure that they're in a good pocket of town. And then, we've certainly have, made several offers on some of the lease up stuff, even, right? Brand new construction that's in lease. So it's just a little bit of a range, but the overall majority of the focus is it's on that B product, 80s, 90s, maybe early 2000s, property. Yeah. Mm-hmm.
And why is that shift? Because I understand like you have had a success managing some of the deeper value adds properties.
Yeah. Well, I think they come with a little bit more risk. And so you have to make sure that you're getting the return for that additional risk, right? And the way pricing is today, sellers they're not giving any ways on that, right? So it's like you're trying to sell me a property that has that's more additional risk, that's more of a heavy lift, but I can go down the road and get this B property that's just a clean middle of the road type of interior renovation, deal, and it's the same cap rate or similar. Then I'm just gonna go with the B property all day long. So we love turning properties and improving them, but if it's not a pricing break, then you just can't do it.
Yeah. So you're kind of noticing the value add projects are now kind of pricing similarly, or people perhaps projecting more on the deep value adds than there is to it.
Yeah. I mean, I've been seeing like A, B, C. There's not like between A class, B class, C class. With A class obviously being the lowest cap rates. I mean, the C properties are not too far away though. And it's like, man, you're taking so much more risk on this older property that's, yes, you can change the exterior and make it prettier, and you can change the demographics to a point. But you still have the old plumbing, you still have the old electrical, the same, it just, those type of things that are behind like the skeleton are still the same, right? 56-year-old plumbing and electrical. So I think the other thing on that is that, if we do have some sort of correction in the market, I think that the class C deals the cap rates are going to rise faster than the A's and B's. And that's just my theory. There's nothing out there that really I can reference. It's just my theory that, if we have a correction, I think that the C properties, even though there's a big part of demographics that they're going to be renting, the cap rates are just going to go higher quicker versus some of the A's and B's. They'll kind of hover around the same point. So I think there's a little bit less risk on those.
Got it. And I understand going into A class building as quite a bit different in terms of modeling difference because you don't have the elements of a value add. So how do you kind of like think about these? How if you see a B operator, how do you think about A class buildings?
Yeah, so a class A building, and we looked at many of them here lately as well. You have to look at it from a different lens a little bit, right? Like you said, you're right. It's a brand new building or maybe 2 or 3 years old. So you're not going to need much on the exterior, right? It's going to be very, very, very clean, very nice, very trendy. But so what's the upside? Where do we see the upside? Well, a lot of the developers, what they're doing is they are targeting, say the market is $2,000 a unit in rent. Well, they're maybe, marketing $1,600. They get it leased up. They take a lot of their risk off the table. Then they sell it to you as a value add because it's an economic value add that you can go in there and then, hey, you have a $400 rent bump that you can do to get to the market, and that's your lift that you take. So that's what a lot of these developers are doing. Like once they finish leasing up, and then in addition to that, some of the properties that we're looking at are like, say maybe they're 10 years old. So it's like maybe like a 2010 year building, and so those properties. The interiors will already be like outdated, right? So we can go in there and add like, quartz countertops and different cabinets or different colors and just do a few things, spend, $5-7 grand a unit. And that's the value add on those, right? So it's there's a couple of different ways there, but yeah, you gotta know the market for sure.
That's awesome. And that's awesome. And I understand you have 3 little cute kids, and what are you doing today to help them be financial literate?
Yeah, that's a great question. I mean, so my oldest, I made him read the Purple Book when he was 4 years old. I have a video of him, like he actually said with that book on his face, and it was like you see him breathing, and it's like the book is going up and down. And so he read it, and he still reads it, like, just not trying to brainwash them, but like just to them to like really get it in their head, like, hey, understand assets versus liabilities. You want assets, right? Understand the
Yeah.
difference, because that's really key. And then in addition to that, that 20 unit, I have a 20 unit building that I acquired a couple months ago, and I gave them all some equity. So all their savings, I told them, give me all your savings. I didn't give them a choice. I made them give me their savings, which wasn't much, right? It's just,
But
we can go to dinner or something, right? Maybe. And so I made them give me all their savings, and then I say, hey, look, you're getting equity on this deal, and I showed them the percentages. So my oldest is 14, my middle is 10, and then my youngest is 7 years old. So they're not too young, but they're also not too old. But they're able to like really look at the model of the spreadsheet and say, hey, look, this is your percentages, and this is what you gave me, this much money, you're invested in here, and then we'll go out to the property and make them be there and really like clean things up or whatever, right? That needs to get done.
but
And just so like that they can be involved, right? Because I think it's very important that you get them involved early and make them feel a part of it. Because if you're doing all the work, then they're not gonna really see the value, and they may not really respect that as much as they get older, right? So
yeah,
so yeah, that's what I'm doing. So I think it's cool, to be able to get them involved.
that's
Yeah.
awesome. Yeah, that's awesome. Well, awesome. Well, thank you so much, Juan, for our show today. Thank you so much for being here today. And last question I have is, how does other people find you? The best
Yeah,
way
no,
to get in touch with you?
yeah, Elisa, what thank you. It was my pleasure. I certainly appreciate that. If somebody wants to get a hold of me, they can reach out to me through social media at the Juan Vargas. Just I'm all over social media, Twitter, Instagram, Facebook, LinkedIn. And then if they want, send me an email, Juan@genwealthcapital.com, Juan@genwealthcapital.com, or visit the website genwealthcapital.com, and happy to help, or talk shop, with anyone out there.
Yeah, definitely. And we'll put these contacts on down to the show notes over here. If you like our show, please give us a like or subscribe, or put some comments in over here as well. And if you wanted to see some future shows on any of the guest questions, just let us know as well. So thank you so much, Juan, today for your time.
No, it was my pleasure. It really was. Thank you so much, Elise. And for everybody out there listening, thank you much as well.
Awesome. And then this wraps our another episode of 10,000 Roads to Financial Independence. And we'll see you next time.